Now, let us try to understand this with the example from the real world of options trading, which is in the stock market. Let's take an example of real stock, like say Reliance, and then try to understand all the different terms that we have learned from the definition. So here is the example. If the price of a Reliance stock is rupees 2000 per share in the market, then an option contract can be written by the seller who is ready to sell this Reliance share at rupees 2100 by the end of the month. Let's assume that this is the beginning of the month, and by the end of this month, he is ready to sell the share at rupees 2100. For this, he is going to collect a premium fee of rupees 20 per share. Okay, so he is going to collect from the buyer 20 rupees per share and ready to write a contract and give the contract to the buyer saying that he is ready to sell this at rupees 2100. The main motive behind the seller writing such a contract is he thinks that the price of Reliance is not going to go beyond 2100 by the end of this month. And what does the buyer have the motivation? He is thinking that the price of this share might go beyond 2100 and he is ready to block the profit by paying a small token amount of rupees 20 per share and locking the price. So if the price of this share goes to say 2200, the buyer has the contract with him to buy the shares at rupees 20, sorry, at rupees 2100 because he has paid the token amount or the option premium, to be exact, as per the terminologies used in the world of options, that he has paid that rupees 20 so that he can buy the share at rupees 2100. He has those rights to buy that share at that specific price. Okay, so this is the scenario. Let's try to bisect the statements or the terminologies in this particular statement to understand it much better. So the stock in place that we are talking is Reliance, and its current market price is 2000, and the strike price chosen for the contract is rupees 2100. So what does that mean? 2100 is the price at which the seller is ready to sell the Reliance share and the buyer is ready to buy the Reliance share at rupees 2100 only by paying a small uh, option premium called as rupees 220. And what is the contract period? It's not forever, it is just until the end of the month. So before the end of the month or on the end of exactly at the end of the month, okay, there is an expiry date. By that time, if the price of Reliance share is either 2100 or below, then the buyer is not going to exercise his rights because he is going to get to buy the shares at a cheaper price in the real market itself. But say suppose if the price goes to 2200 or 2300, he will then go to the seller and say, okay, I have the rights to buy this at 2100, give me the shares. Since he has blocked the or locked the price of the Reliance share at a specific price by paying the option premium to the seller, he has all the rights to exercise that if he wants to. Okay. But can he do it for just one share of Reliance? No. It has to be done with the lot size. So, lot size for Reliance stock as of today is 250 shares. The lot size varies from stock to stock. Okay. So, the lot size of Reliance is fixed at 250. And for something else like say Infosys, it could be like say 500 shares, or for HDFC Bank it can be just 100 shares. So it depends per stock, and this information can be obtained from the NSE website. Okay, and the SEBI actually revisits the lot size every quarter, I believe, so that you need to always keep an eye on it, or even your broker would be like intimating you as and when it changes. Okay, so as I said, the rupees 20 that the seller collects from the buyer per share of Reliance to lock the price at 2100, which is the strike price. So when he multiplies this rupees 20 for 250 being the lot size of Reliance stock, it comes to rupees 5000. So 5000 is the amount that the buyer is paying the seller to block the Reliance shares price at rupees 2100. Okay. All right. So let's get into a little more details and understand some of the common questions that you might be having at this stage. So why was the strike price chosen as 2100? Can it be anything different? We will talk about it. Is the option premium rupees 20 predefined, or does it change over time, or who decides this price? How is the lot size determined? What are the different contract expiry dates? Should I wait until the contract expiry to get the profit or loss? Let's try to answer each of these questions so that it clears some of the confusions. Okay, the first question, why strike price is chosen as rupees 2100? So there is no specific rule. It can be, you can choose the strike price as 2100 or 2200 or 300, whatever it is. Okay, you, from the current market price you could go either left or right. Okay, so the farther you go, okay, so the token amount that the seller receives from the buyer is higher if the price of the strike price is closer to the current market price. So just think about it. The current market price of Reliance share is rupees 2000, and the strike price he has chosen, or like he has agreed upon to write the contract, is rupees 2100. For this he is collecting rupees 20 as the premium. What can be, okay, it need not be a specific or a certain amount. Just try to think what could be the token amount he would collect for a strike price of 2200, which is 200 rupees more than the current strike price, sorry, current spot market or the current market price of Reliance share. It will definitely be less than rupees 20. Okay, because the probability of the Reliance share reaching 2100 is much higher than it reaching rupees 2200 by the end of the month, right? And similarly, if you go even further far, like say 2300 or 2400 or 2500, the premium that the seller can collect will reduce much less. Okay, the reason being, the farther the strike prices are chosen, the probability of the underlying stock reaching the faraway strike prices reduces. Okay, and hence the premium that the seller can collect also reduces. Okay, all right. Is option premium rupees 20 predefined, or does it change over time? This is a good question. Let's try to take the same example here of Reliance, which was at the beginning of the month, the current price was 2000, and the strike price at which this contract was written is 2100, for which the option premium was collected at rupees 20. But say suppose immediately there is some extremely good news that has come, and say Facebook has acquired 10% stake in Reliance, and immediately the price of the Reliance stock goes to 2100 very next day. Okay, then what do you think the price of the option premium would be? It would be like say going up like say 50 or 60 rupees or something immediately the next day. Okay, so the price of the option premium changes over time. If the current market price is getting closer to the strike price, then the price of option premium also keeps changing and goes up. Okay, and say suppose it stays at 2000 or it goes below 2000, there is some bad news and actually market crashes, and the price of the Reliance stock falls to say 1900 or 1800, then the option premium for 2100 would drop from rupees 20 to say 10 rupees or 5 rupees. But if you are also going closer to the contract expiry date, then the decay or the change of option premium price will also be very high. So today it is rupees 20, although the price of the current market price of the Reliance share is 2000. Since you have 30 more days approximately for giving chance to Reliance share to reach 2100, you are ready to pay 20 rupees. But say suppose you only have like 3 days left in this month, would you be willing to pay rupees 20 still if the current market price is 2000? No, because the chances of or probability of the Reliance share reaching 2100 within this short span of 3 days is highly unlikely, and hence you would not be willing to pay rupees 20. So probably you might be willing to pay like 2 rupees or 3 rupees for it. Okay, hence the option premium has dropped drastically there. So the conclusion here is the premium of the option keeps changing as the current market price of the underlying stock keeps changing. Also, apart from the underlying asset price, it also depends upon the volatility in the market, and also the time value left in the contract. So that decides the price of the option premium. Okay, all right. Let's see the next one. How is the lot size determined? As I said, the lot size is being defined by SEBI for each stock separately, and there are all the stocks that are available to trade, available in the market, is not eligible for doing futures or options trading. Okay, so you need to follow the Nifty NSE website to see the eligible stocks that are under the F&O segment. When I say F&O, it stands for futures and options trading. Okay, and SEBI determines the size of the lot for each specific stock. So roughly they try to keep the size of the lot uh, which comes around like say 5 to 8 lakhs or sometimes even close to 10 lakhs amount for a specific stock. So in this case, like the Reliance share, the size was determined to be 250, which came around close to 5 lakhs, I believe, when they actually decided to set the size as 250 shares per lot. But now the same lot of 250 shares is going, I think, beyond 6 or 7 lakhs, I believe, because the price of the Reliance share has gone up from the time when the lot size was determined. So they will again revisit this and they can again bring it down to like say 200 shares per lot or 125 shares per lot, depending on how high the price of the Reliance share goes up. Also, there is one other statement that you can see here. The current lot size of Nifty is 50 and Bank Nifty is 25. So Nifty and Bank Nifty are not stocks, they are indexes. Okay, so as you can do options trading with stocks, you can also do option trading with the indices. Uh, and we are going to talk about this little more detailed as we go further into the course. But to give you a high level answer here, the volatility of doing the option trading in Nifty is much less, and it is also moderate to less with Bank Nifty, or like I would say moderate to high with Bank Nifty, and it is extremely high and volatile with doing options trading with stocks. Okay, what are the different contract expiry dates? So the expiry of contracts can be written either weekly or monthly. Okay, so when I say weekly, it is every Thursday there is there is an expiry date of the contracts, and you can also write month end expiry of the contracts, which also again falls on the last Thursday of the month. And if Thursday of a particular month or a weekly contract expiry date falls on a holiday, it would be the prior day, prior business day. So if say suppose this week Thursday is a holiday for the stock market, then the expiry date would be moved to Wednesday. All right. Should I wait until the contract expiry to get the profit or loss? The short answer at this time is no. It is not required for you to wait until the contract expiry for you to realize your profits. So to understand it a little more in detail, let's take or consider the same example here. If there is some super good news about Reliance stock out there and it reaches the target of say 2100 within the first couple of days of in the month, then the option premium of 2100 strike price would go from 20 to say like 70 or 80 rupees. In such scenarios, the buyer who has the contract to buy the Reliance share at 2100 by the end of the month can actually sell that contract to someone else who is interested uh, for this contract at the price of say 70 or 80 that the option premium has reached within the first couple of days. Okay, so that he can pocket the profit and go and do some other trade. Okay, but say suppose if the price is staying at the same level of say 2000 or going to 2050 and again coming back to 2000 or dropping to 1900, then what happens is as the time progresses and as the expiry date reaches, the contract expiry date reaches, the option premium would slowly and gradually drop from say 20 to 18, 17, 15, 10, and also it would reach zero if the price stays below 2100 by the end of the contract expiry. Okay, so with this, let's now look at the different option types. You would have got a fair amount of idea on the basics here with what the option is and how the contract works and what a strike price is, what is an option premium and how does it vary. We are going to look into the more details about it also and get a better understanding of all these concepts that we have discussed so far as we go deeper into the course. Okay, and now at this point let's get into the topic of option type.